Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, and this is a one-year daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. As I zoom in here, you'll see that I left my forecast lines on the chart from last week's report. Many of you who have been following along know that the end of the line, when I draw that diagonal line, the end of the line represents my target price for the following week. And as you'll see, the Dow hit my target exactly at 340.71 and even surpassed that. Now, what does that mean for next week? Well, if you take a look down at the oscillators down here, you'll see that the CCI crossed above the zero line, aka the momentum line. So there's a good chance we're going to continue with that upward momentum early on next week, maybe Monday and Tuesday and Wednesday. So what I'm going to do is draw that to represent the upward move Monday and Tuesday. And then I do believe that we're going to bump our heads against this resistance right here and then start to pull back, because there's a gap down below the market down here that's been left unfilled, and 80% of the time gaps fill. So I'll erase those lines now that we hit those targets. I'll leave my new lines in place for next week, and we'll have to see whether or not the oscillators begin to turn down as we approach that resistance line up there. That's for the diamonds. We take a look at the spiders, ticker symbol SPY, same scenario. Left my lines on the chart. You'll see again that we surpassed my target, which from last week was 419.09. And interestingly enough, we have the momentum still persisting to the upside on higher volume for SPY. So I think we're going to go a little bit higher like the Dow. And then we get into this area where we have a wide divergence from the 20-period moving average. So I think we will then begin to pull back to that moving average. I'll try to keep that to the timeline as best that I can, because next week, or I should say next weekend, the markets are closed on the 5th of July in observance of the 4th of July holiday. So we're having a 3-day weekend. So that may have an effect as investors move to cash out of any long positions. That may put some pressure on the markets again towards the end of the week. Keep in mind that down below, we still have an open gap down here. I think that'll ultimately fill, but we'll have to see after the market turns around. I'm going to give you some data to think about, because these oscillators down here are very predictable. In fact, if you see that as I zoom in, you'll see not only did I put the price action up at the top on the price candles, but I also forecasted the pivot point on the stochastics, and I also drew that line. It's hard to see because it looks like the CCI followed that line exactly. You see that as I zoom in there? You'll see that that's what happens. So you want to keep an eye on these pivot points as the CCI especially starts to go down. That's a good idea for you to maybe trail your stops, take some profits off the table, move to some cash, and then reposition on the next buy signal. So that's for SPY. Going to flip right to the VIX. On Monday, we came very close to hitting my target here. Remember, I left that line from the week before, and I just drew it parallel. We came very close to hitting that target, and now we pulled back, formed a hammer pattern here, which is bullish. But this red candle, again, puts a crimp on the upside for the VIX, which, of course, if the VIX is inversely related, you want the VIX to drop when the market's going up. But I think that will happen just very briefly, and then we're going to start moving back up. And what I'm going to do here is I'm just going to leave this line here as the horizontal line. I'm just going to leave that in place because I think that target will hit. I'll erase this line. I'm going to keep this line. This is more or less a hard target line, and I'm just leaving horizontal for the duration. So keep an eye on that. I'll erase this downturn here as we hit that target. And again, even though I think the VIX could drop a little bit, look at the oscillators starting to move up. So that's, again, bearish for the market if the VIX starts moving higher. It's something that I recommend every trader and even investor keep on their watch list. The volatility index is widely followed by many traders, and It's also known as the fear index. So as fear creeps into the market, what happens? People move to cash, they move to the sidelines, and that usually puts pressure on the S&P especially. So that's the VIX. Now, if we look at the Qs, you'll see that this has not pulled back yet, but we have a bearish engulfing candle right there. See that? That bearish engulfing candle is 80% chance we're going to drop. We see a drop in volume here on the way up. That's bearish. Going back up to the candles on Thursday, we had very close to a shooting star. You have a sell signal on the stochastics. Today, we have a pivot point or a hinge in the CCI today. So I'm going to erase that. We did not hit that target, but I'm going to put a new target for you. Again, exactly to the penny. I think the Qs are going to start moving right back to that moving average with the downside price target right there of 343.12. So again, for those that are trading options, that's 343.12. And I'm putting a timeline on that as of July 1st. So that's for the Qs. That's one we missed. We hit on the others. We also hit on IWM. You'll see again, the lines were drawn down here. I said we would bounce off of this support, which was this low right here. We did that. We rallied. We continued to rally. We blew through my target price of 225.06. And lo and behold, what do we have up here? That's a doji right at the top, right at resistance. So now that all these targets have been hit, I'm going to erase that. We no longer need that evidence of the accuracy of these forecasts and the charts. We have enough of that. Right there is resistance. We have a doji. We have an increase in volume on that doji, which tells us there was a battle between the buyers and the sellers as they were fighting out position. Yesterday, we had the drop in volume on the way up. These lower volume candles on the way up are bearish. And then we have the pivot point forming here. So that's why we have an increase in volume. We have a wide divergence from this 20-period moving average now. See that? So that rubber band effect is about to kick in. So what I'm going to do is draw my forecast line on IWM to the downside. You know, the IWM, the Russell doesn't always follow the Dow and vice versa, but I think that we could be hitting our heads against this resistance right here, and next week we'll probably see lower prices with a price target on IWM of 229.82. So that's the diamonds, the spiders, the Qs, the Russell, and the VIX. I want to bring your attention to my Twitter page. If you're not a follower there, go right ahead. It's free, obviously. You can follow along. We have about 36,000 followers there, and it's growing. I posted a report that came out earlier today, and I want to show you this right here. Actually, it came out yesterday. I posted it 23 hours ago. You definitely want to pay attention to this one. This is very well put together, a PowerPoint showing the critical points that we've reached in our economy. They talk about the strategies put forth by the Fed to more or less paint the tape, as they used to say, in with regard to inflation numbers. Inflation is real. The Fed doesn't want it to be this real, but it is. And this is very well worth your time. I'll put a link to this in the description box below, and that way you can go right to the page if you don't rather not go to my Twitter page. Now, one of the other things I want to point out to you is this. I found something very interesting. I took a chart and I overlaid the SPX, which is the S&P 500, to the volatility index. And what I found was a very well pronounced, very well defined cycle, which is a 7-year cycle that began back here in 2000. You see the divergence between the VIX and the S&P at that point was quite wide. And then that repeated again in 2007. Now keep in mind, these red boxes are the areas right before the major crashes that occurred in the tech bubble and then the crash of 2008. And then we see another widening, a very wide divergence there right up in 2015 and into 2016 where we had our sell-off. Now look where we are right now. Again, super wide divergence. In fact, that's the widest divergence we've had in history at this particular point. And we're right on that 7-year timeline with the VIX very close to historic lows. And with all the data that's coming out with inflation and the Fed and everything else that's going on, I show you this as a reminder of how important it is to have a risk management plan in place. If you're not thinking about the downside, I would strongly encourage that you do, because my forecast for the long term is not just a 10 or 20% pullback in the market. I'm expecting what could be the biggest crash that we've ever seen. And I don't say that to be an alarmist in any way, but I just want to make sure people are looking at the downside, because we could make money faster on the way down than on the way up, especially when it's charged with emotions like fear, right? And especially for the option traders. So keep that in mind as we move forward. Please like and share this video, pass it on, make sure we're spreading the word of technical analysis and how good it is for managing risk, and stay tuned to these reports each and every week. Again, if you hit the notification bell, you'll be notified as soon as the video is posted, which I normally put out on late Friday afternoon. So have a great weekend, and we'll talk to you soon. So long.